9:47. AM EST, March 14th. COMEX Silver Futures Trading Desk. The spot price sits calm at $28.40 per ounce. Pull up any major dealer site right now. Go ahead, try to buy a 100-ounce bar. Sold out. Refresh the page. Still sold out. Meanwhile, your screen shows paper silver trading smooth as glass. Check the premium, $2.50 over spot. Last week it was 60 cents. The futures market shows 18% backwardation, near month contracts trading above distant ones. That shouldn't happen in a functioning market. Physical bars are gone while paper prices stay anchored. The spread between what you can buy and what the screen shows just hit 40% higher than normal. Put the phone down and listen. This isn't speculation. This is happening right now. If you think this is just another correction, you're not seeing the system break down in real time. By 10:15 a.m. Eastern, the divergence widened. COMEX futures showed silver at $28.35, down a nickel from the open. Shanghai physical market trading at $32.50 per ounce. A $4 gap between paper and metal. That spread should trigger arbitrage immediately. Buy COMEX, sell Shanghai, pocket the difference, except nobody's doing it. Why? Because COMEX can't deliver the physical metal to complete the trade. The arbitrage mechanism that's supposed to keep these markets aligned just failed. Pull up the dealer quotes. Bid-ask, spreads widening. Inventory counters dropping to double digits on serialized bars. One major dealer posted allocation only across their entire product line. This isn't normal volatility. This is a market where paper promises and physical reality just stopped talking to each other, and the gap keeps widening. While COMEX showed relative calm, liquidity was vanishing. By 11 Tau a.m., bid-ask spreads on physical silver had blown out to $1.80, 10 times normal width. Dealers weren't just raising premiums, they were refusing to quote entirely. Check the major bullion sites. Call for pricing replaced fixed spreads. That's code for, we don't know what this is worth because we can't source it. Trading volume on COMEX remained normal, paper contracts changing hands like nothing was wrong, but try to convert that paper to metal and the system seized. One institutional desk reported a 2-hour delay just to get a quote on 5,000 ounces. The liquidity vacuum was forming exactly where it matters. At the conversion point between contract and delivery, this is where markets break, not in the price, but in the mechanism underneath. By noon Eastern, dealer inventory snapshots told the real story. Major online retailers, out of stock across 90% of product lines. Serialized 100-ounce bars, gone. Generic rounds, back-ordered 4 weeks. 1-ounce government coins, temporarily unavailable. Meanwhile, COMEX open interest sat at 180,000 contracts, each representing 5,000 ounces. Do the math. 900 million ounces of paper claims. COMEX registered inventory, 47 million ounces. That's a 19-to-1 ratio of paper to available metal. Now, watch what happens when even a small percentage tries to take delivery. Premiums climb to $3.20 over spot by 12:30 p.m. Buyers who held paper positions were forced to chase physical at inflated prices or accept cash settlement at values that didn't reflect real scarcity. This isn't volatility. This is a run on a fractional reserve system, and it's escalating by the hour. The Shanghai close revealed the full picture. Silver on the Shanghai Futures Exchange settled at $33.10, a full $5 above COMEX pricing. $5. In a normal market, that gap closes in minutes through arbitrage. Instead, it widened. Why? Because Western paper markets can't deliver metal to Eastern physical markets at these prices. The divergence wasn't a mispricing, it was proof the system couldn't connect supply to demand. Institutional traders who'd been shorting COMEX futures while buying Shanghai physical were trapped. The arbitrage worked on paper, but failed in practice. Delivery times stretched to 8 weeks for large orders. One Hong Kong dealer reported, "No inventory, no timeline, price negotiable." Translation: they'll sell you something they don't have, at a price they'll determine later, if they can source it at all. This was the signal. The global silver market had split into two separate realities. Premiums surged past 60% above historical norms by 3 p.m. Physical 1-ounce rounds that normally carried a $2 premium were selling for $5 over spot, when available. But here's the trap. COMEX contracts were still settling at paper prices. If you held a futures contract expecting delivery, you got cash instead, at $28.50. Then you had to turn around and buy physical at $34. You just lost $5.50 per ounce in forced settlement. Multiply that across institutional positions, and you're looking at catastrophic losses. The paper market offered no deliverable metal, only cash compensation at prices disconnected from physical reality. One futures trader described it as getting paid in monopoly money while rent's due in real dollars. The premium surge wasn't speculation, it was the market pricing and the probability that paper promises couldn't be kept. The global squeeze intensified as Eastern markets opened for their next session. Backwardation deepened to 22%, the steepest inversion in silver futures since the Hunt brothers crisis. March contracts trading above June contracts, June above September. That's the market screaming, "We need metal now, not later." But there was no metal. Global mine production runs about 800 million ounces annually. Sounds like a lot until you realize industrial demand alone consumes 600 million. Add investment demand, jewelry, and you're in deficit. Now layer on a sudden rush to convert paper to physical, and the math breaks. Shanghai reported dealer inventories down 70% week over week. London vaults showed drawdowns of 15 million ounces in 10 days. The supply wasn't coming, demand was skyrocketing, and every contract holder was doing the same calculation. Can this system actually deliver? By the next morning, forced cash settlements were hitting institutional accounts. March contracts expired with physical delivery requests exceeding available registered inventory by 40%. COMEX invoked settlement at the paper price, $29.10. Physical market price, $35.50. The 22% gap meant anyone expecting delivery took a massive loss, but it gets worse. Those forced cash settlements created immediate buy pressure in the physical market. Now you had institutions with $50 million in settlement cash trying to buy actual metal in a market with shrinking supply. They bid prices higher, widening the gap further, forcing more cash settlements, creating more buy pressure. A doom loop. One London desk reported executing a 100,000-ounce physical buy that moved the market 1.20 in 15 minutes. The paper system was generating its own destruction, every settlement proving it couldn't deliver, every failure driving more holders to demand physical. Lease rates told the story institutions didn't want published. Silver lease rates, the cost to borrow physical metal, spiked to 15% annualized. Normal rate, under 1%. A 15% lease rate means there's almost no metal available to borrow, and what little exists carries catastrophic risk premiums. Short sellers who'd been borrowing silver to sell, expecting to buy back cheaper, were now facing forced buybacks at explosive rates. The math: borrow at 1%, sell at $28, buy back at $35, pay 15% interest on metal you can't source. Some shorts faced losses exceeding 40% in a week. Worse, many couldn't close positions because there was no physical metal to return. Exchange notices went out. Deliver or face penalty. But deliver what? Inventory had vanished. Backwardation and lease rate spikes weren't technical signals anymore. They were proof the short squeeze had gone kinetic. Then geopolitics entered the equation. Russia announced export restrictions on strategic metals, including silver, citing national security. China's state media ran articles emphasizing commodity sovereignty. India raised import duties on precious metals. Suddenly, this wasn't just a market squeeze. It was nations locking down supply. Western paper markets relied on global metal flows to maintain the illusion of deliverability. Cut those flows, and the system collapsed faster. One analyst noted, "When countries start hoarding commodities, it's not speculation. It's preparation." COMEX inventory dropped another 3 million ounces overnight as holders withdrew metal to private vaults. The remaining registered silver, metal available for delivery, fell below 40 million ounces. Against 180,000 open contracts, that's a 22-to-1 paper-to-metal ratio. The global squeeze was tightening, and geopolitical controls were cutting off the escape routes. By week's end, the physical market was effectively gone. Dealer sites showed out of stock or pre-order only across all major products. The few available bars carried premiums of $8.10 over spot. COMEX spot price still anchored near $30. The divergence had become absurd. Paper said $30, metal cost $40. Anyone still holding paper positions was locked in a trap. They owned claims on metal that couldn't be delivered at prices that didn't reflect reality. Meanwhile, buyers who'd secured physical weeks earlier sat on 30% plus gains. The inventory depletion was total. One vault operator reported, "We have clients offering 20% premiums for immediate delivery. We have nothing to sell them." This was the final squeeze phase, when price becomes irrelevant because supply simply doesn't exist. The endgame mechanics were simple and brutal. COMEX registered inventory approached 35 million ounces. Open interest remained above 175,000 contracts, 875 million ounces of paper claims. The ratio hit 25-to-1. Premiums reached 100% above normal levels. Serial numbered bars, if found, sold instantly at any price. The system couldn't reset because there was no mechanism to force sellers to deliver what didn't exist. Cash settlements continued, each one confirming systemic failure. Institutional holders faced a choice: accept cash at paper prices and watch purchasing power evaporate, or chase physical at premiums that kept rising. Either way, losses were locked in. One trader put it simply: the paper market promised delivery. The physical market said no. Guess which one wins? The dominoes were falling, and the worst hadn't even started. What happens next isn't speculation, it's math. The spread between COMEX paper and Shanghai physical hit $7 per ounce, then $9. Sustainable? No, but closing it requires physical metal moving west to east, and that metal doesn't exist in available form. Backwardation persisted, lease rates stayed elevated, and inventory continued to drain. Every metric pointed the same direction. The paper system couldn't hold. Watch for forced delivery notices. When institutions demand physical and exchanges can't provide it, that's when the real price discovery begins. Current signals: premiums still climbing, inventory still falling, spreads still widening. The squeeze isn't ending, it's compounding. This crisis isn't a flash event, it's a structural break that will drive price escalation until someone adds massive new supply or paper holders capitulate entirely. The final data point closed the case. March 21st, 4:15 p.m. EST. Silver spot on COMEX, $31.20. Physical dealer quote for immediate delivery, $42. That's a 35% premium over paper. Not a mispricing, but a market screaming that paper and physical have permanently diverged. COMEX registered inventory, 33 million ounces. Open interest, 172,000 contracts. Ratio, 26-1. In 72 hours, silver had effectively jumped 40% in the physical market, while paper prices barely moved. The system couldn't deliver, couldn't arbitrage, couldn't reset. One vault manager's final comment summed it up. We're watching a fractional reserve system realize it's fractional. Watch the premiums. Watch the inventory. Watch the spreads. The squeeze isn't speculation anymore. It's documented, observable, and accelerating. The paper illusion just shattered against physical reality.